Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Before we get started, today's video is going to be a shortened, condensed version of what we usually do in our SPX videos. So in this particular video, we're not going to go over all the different aspects of the indicator. We're mainly just going to go over today's trades for this particular session. If you are not familiar with the SPX Daily Key Levels indicator, then look in the description of the video underneath the video on YouTube, and you will see in the description these particular links that go into more details about how the indicator works and the trading strategy. So there's a video overview as well as additional resources with a Google Drive link for descriptions links to other videos on different topics about the SPX indicator, and then there's also links to longer that are hour to an hour and a half long SPX trading videos that will go into a lot more detail about the indicator and the daily key levels strategy. If you click on this Google Drive link, we'll show you what screen that takes you to. That'll take you to this particular document, which will have links to other specific topics that are covered about certain aspects of utilizing the indicator. Thank you. Hello, in today's video we'll be taking a look at the Wednesday, January 21st, 2026 trading session for the SPX CBOE index. We'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator, specifically the V2.0 version of this indicator, which was just released a few months ago. Okay, so some of you may be already familiar with how this indicator works from seeing our other videos on this channel, but for those of you who are new to this channel, who have never seen a video on this indicator before or our key levels trading strategy, I will briefly go over how this indicator works before we get into the trades of the session. Also, as pointed out in the preview of this video, we do have other videos for longer session videos that go into more details about the indicator, as well as other videos on specific topics about the indicator. And you can find the Google Drive link to that document about the other specific topics about the indicator in the description of this video, as well as the links to the other longer session videos. Okay, so first off, this indicator works on the TradingView platform only. You can, of course, make your trades as far as your SPX option trades through any broker, such as Thinkorswim or E-Trade, TradeStation, Webull, Robinhood, or one of the many brokers that do handle SPX index options. However, as far as charting purposes, this indicator is only for use on the TradingView platform. This indicator, the V2.0 indicator, works on the SPX CBOE index symbol, which is the one that you see it on now. So in TradingView, you would type in under symbol search SPX, and then you would look for the SPX symbol under the CBOE exchange. The indicator also works on a second symbol, which is the SPX 500 8 cap, which I'll show you now. So in TradingView, you would type in SPX 500, and then you would look for the SPX 500 symbol under the 8 cap exchange. There are a couple of reasons why it works on two different symbols. One reason that you would want to have it on the SPX CBOE symbol is, of course, if you're trading SPX index options, that is the symbol that you would use because that is the official SPX index that everyone follows. as far as the SPX 500, you would utilize the indicator on this particular symbol if instead of trading SPX index options, you instead prefer to trade SPX through your Forex broker if you have a Forex account. And the SPX 500 ACAP is a CFD, a Forex-based CFD. So if you have a Forex account and you prefer to trade SPX on Forex instead of uh, using SPX index options, then you would utilize the indicator on the SPX 500 ACAP symbol. Another reason might be if you're taking a Forex-based trading challenge such as FTMO or the 5%ers or Apex or one of the many 60 or 80 or so Forex-based trading challenge companies that exist, in which you pay a fee to take a trading challenge and they assign a daily loss limit and a total loss limit on your challenge. And if you're able to meet the profit target on the challenge account without violating the daily loss limit or the total loss limit, then you can get a funded trading account with them, which they would provide the risk capital on that trading account, and then you have a profit split with them, which you typically receive somewhere between 80 to 95% of the profits, depending on the company, and then the balance goes to the company, the smaller percentage. And of course, that's based on you not violating your daily loss limit or total loss limit in your funded account if you are indeed awarded one from passing the challenge. So a third reason why you would want to use it on the SPX 500 symbol, even if you are trading SPX index options and normally would use this indicator on SPX CBOE symbol, would be that if you have it on the SPX 500 ACAP symbol, let's say you open up a second chart, you can get the levels for CBOE SPX index 30 minutes before it opens at 9:30 a.m. Eastern New York time. So the SPX CBOE index does not trade in the pre-market or the overnight session, and whereas the SPX 500 8-cap Forex CFD does. So normally, if you would use this indicator on the CBOE SPX index and you don't have a second chart open for SPX 500, then you're only going to get the levels for CBOE SPX starting with the first tick of the 9:30 a.m. market open when that index opens. However, we've designed the indicator so that if you have it on the SPX 500 chart through the ACAP exchange, then at 9 a.m., which is 30 minutes before the CBOE SPX open, as we've marked off here, then that is when you would get these two tables on your SPX 500 8-cap chart, one of which is for, of course, the SPX 500 8-cap, which is all these levels here. These are specifically for the symbol that the chart is on. However, there's a second table that the indicator produces here, which gives you a 30-minute early preview of what the CBOE SPX index levels are going to be for today's session. This allows you to get a 30-minute jump on the session to do some more planning and gives you a little bit extra advantage as far as having the levels early. Okay, so now we're back on the main CBOE SPX chart, and we're going to run down what these levels are on the chart. Now, normally the default display levels are going to be this bull bear key price level here, the bull bear KPL. That's your most important key level for today's session, which for today's session 67.97.51. The other main key levels on the V2.0 indicator are going to be your R1 through R6 levels above the bull bear KPL and your S1 through S6 levels below the bull bear KPL, which are also shown here on this optional table, which you can turn off in the user control panel if you do not wish to have it on your chart. Now, what is the reason why we don't have all 6 levels showing above and below? Well, that is because, as you can see here, if we have all 6 levels, then the chart looks fairly squunched up here. And in the main start of the session, you're primarily going to be concerned with R2 down to S2 or R2 down to S1 or some variation thereof in that range here because of the other important levels surrounding the bull bear key price level. Because in 95% of the sessions, your bull bear key price level is going to be your 9:30 a.m. opening candle trade in most sessions to make a decision on as to whether you would like to take the opening candle trade. And so there's really no reason to have R4 through R6 or S4 through S6 or even really the S3 through S6 open uh, during the first part of the session. So what you do is you just simply go over to the right price axis and you left click your mouse and you drag and expand your chart. Now you want to try to keep these YDH, YDL, PML, YDC, and PMH levels on the chart as well. And so you would expand your chart as I've shown you here on the right price axis by using the left click on your mouse, holding it down, and expanding it out until you find the view that you prefer for the opening session. Now, as far as the levels that are typically shown on the default display of this indicator on startup, they're going to be the bull bear KPL level, the QL above the BBKPL, the QL below the BBKPL, the first midpoint level above the bull bear KPL, and the first midpoint level below the bull bear KPL, along with your main R and S levels above and below. These other levels that you see here were turned on manually by us in the user control panel as the session progressed. So these are normally not shown on default startup. However, with this indicator, like other TradingView indicators, you can modify the default settings in the user control panel as far as what you prefer on startup, if you prefer a different look on startup as far as what levels are enabled than what we present to you as the default display. Just wanted to point out that these levels here that you see, these midpoint levels here, this QL level here, and this QL level here, those were all turned on manually. So that's very easy to do in the user control panel. You just simply go in here and you would go down to the different sections here. So here's the midpoint line settings where you can enable or by checking, or you can disable it by unchecking what levels you prefer to see as far as midpoint levels. And then we have the same section for the QL levels where you can do the same thing as far as enabling or not enabling them. Now, what about these other levels here? The SPX PMH, that is the pre-market high. SPX PML, the pre-market low, which is here. SPX YDL, that's yesterday's daily low. That is the previous session's RTH session low. YDC, yesterday's daily close, the previous session's RTH session close. And YDH is yesterday's daily high, the previous session's previous RTH session's high. Those are also very important key levels as far as context of the session. So for example, if you're going to have a very bullish day, generally speaking, in most sessions, you're going to not only have to get above the bull bear key price level, but also get above the PMH level. And conversely, for bearish sessions, not only are you going to have to start closing and holding below the bull bear key price level, but also closing and holding below the pre-market low, generally speaking, in most sessions to get a substantial move to the downside. The YDH, YDC, and YDL levels are also very important as far as market structure in the relationship to the PMH and PML levels. They can also serve as decision points for exits and also for gauging continuing momentum as we saw in today's session when we finally got to the YDH, the yesterday's daily high. We stalled out here and then began reversing back down. And then as you can see here, we went below the PMH eventually, tried to go back above it, and then continued to move down below it. Okay, so now we're going to look at the different trades of the session. As I mentioned before, you can look at other videos on specific topics of this indicator by going to the Google Drive link in the YouTube description of this video. Click on that link and you will see various topics concerning use of this indicator, which delve into more specifics on certain topics, and I would invite you to take a look at that. And we also have links to other SPX session videos, which were a lot longer, which go into more detail. Okay, so there were two trades today. We're going to look at trade number one first. Trade number one was off of the 9:30 a.m. opening candle. Before we jump into that, I'm just going to clarify a few things about the indicator before we jump into the first trade of the day here. So with the V2.0 indicator, your main key levels are the levels that you can take your bullish or bearish trades from. So what do I mean by the main key levels? The main key levels are the bull bear KPL level and the R1, R2, R3, R4, R5, and R6 levels above, and the S1, S2, S3, S4, S5, and S6 levels below. The midpoint levels and the QL levels serve completely different purposes, as you'll see as we go through the different trades here and explain how those levels are used. But just for simplicity's sake right now, just know that the main key levels are you can take trades, bullish or bearish trades off of any of the main key levels with this particular indicator. And we do have a video on taking trades off of any of the main key levels and explains taking bullish or bearish trades off of any of the main key levels, as well as explains both types of trade entries, a standard trade entry, and then the more conservative trade entry, which takes additional confirmations. And then we give several examples of each of those in that video as well. And the link to that video is found in the Google Drive link in the description of this video. All right, so the 9:30 a.m. opening candle we have marked off here. As you can see, it opens and also closes above the bull bear key price level. However, in today's session, we're seeing an example of the 9:30 a.m. opening candle closing above the bull bear key price level, which normally would be a trade off of the bull bear key price level, a bullish trade based off the bull bear key price level. However, in today's session, there was some news that came out after 9 a.m. regarding President Trump and him backing off of Greenland, of a military invasion of Greenland. And so the market continued to spike up between 9 a.m. to 9:30. So in this particular session, we have the opening candle, which is opening way above the bull bear key price level. It opens above, in this case, not opens above, it closes above the R1 level. So as we noted here, 9:30 a.m. opening candle closes above R1, 68.1328. The close of the candle is out of the acceptable range for a BBKPL level-based bullish trade. So what we mean by that is this candle is too far above the bull bear key price level that it is out of range for basing the trade on this level. Because when you're basing a trade on a specific level, that triggers what stop losses that you are going to use and also what profit targets you're going to use. And depending on where the candle closes, in this case above, if it is closing out of range, that means that there's no trade for the bull bear key price level. And then you would look at specifically at the level that it is tagged to in its close. In this case, that is the R1 level. So it's still a bullish sign that it is closing above the bull bear KPL level. However, for taking a trade, you would now base it off of the level that's in play, which in this case is the R1 level. So if you're going to take this 9:30 a.m. opening candle trade, you would base your trade on the R1 level and the stop losses corresponding to the R1 level for a bullish trade rather than the bull bear KPL. So we have a specific video on what is considered in range and what is considered out of range for not only the 9:30 a.m. opening candle, but other levels as well. It is a consistent percentage throughout all of the levels, but if you take a look at that video, which is also found in the Google Drive link in the description of this video, and you simply look for the topic of 9:30 a.m. opening candle trades to avoid, and what that specifically means is 9:30 a.m. candle trades to avoid based off taking them off of the bull bear KPL level. There's also an accompanying PDF to that document, which goes over what constitutes the acceptable range and what constitutes being outside the acceptable range. And that process of within acceptable range and outside of acceptable range also applies to any taking bullish or bearish trades off of any other of the main key levels. Those, of course, again, being the R1 through R6 or S1 through S6 levels. So if you'd like more information concerning that topic, just take a look at that video and the accompanying PDF document that goes along with that video. Okay, so this trade is going to be a bullish trade based off the R1 level. So we have a bullish entry R1 level on the 9:30 a.m. opening candle. As you can see here, the candle closes above, even though it started below. So the most important thing is, where is it closing in relationship to the level that you're looking at? Also, if looking for additional candles for confirmation of entry, alternative entry candles for the R1 bullish trade occurred between 9:32 a.m. through 9:42 a.m. So that's these candles here. All of these succeeding candles are still within the range, and they're still all closing above the R1 level. So if you missed or decided to you wanted to ignore this opening candle and just wait to see how price played out more, and you did not want to take this 9:30 a.m. opening candle trade, you could have re-entered here or one of these candles that occurred from 9:32 a.m. to 9:42 a.m. And we have the range here that we'll go over in a second of what the entry prices would have been on the ask during that 9:32 a.m. through 9:42 a.m. range. And of course, we're on a 2-minute chart. So the 9:30 a.m. candle closes at 9:32 a.m. The 9:32 a.m. candle closes at 9:34 a.m. And of course, this 9:42 a.m. candle closes at 9:44 a.m. Now, what about stop losses? Stop losses are based on the directional trade that you're taking, whether they're bullish or bearish, and the specific level that you're taking the bullish or bearish trade on. So in this case, it's a bullish trade off of the R1 level, and your tight stop loss is going to be the QL level below the level you're taking the trade from, in this case R1. So QL below R1 is the tight stop loss if you prefer to use a tight stop loss on this trade. The standard stop loss is the first midpoint level below R1, which is this level here, mid BBKPL R1. So if you prefer to use the standard stop loss, this would be your stop loss on the entry if preferring to use the standard stop loss. And this stop loss combination or choices is the same on taking bullish or bearish trades off of any other level. So for example, if instead we were looking at a bullish trade off of the bull bear KPL, if this candle was not out of range and it was more down in this range here, and we were instead looking at a bullish trade off of the bull bear KPL level, then our tight stop loss on that trade would be the QL level below the BBKPL, and our standard stop loss on that bullish trade from this level would be the first midpoint below. And it works the same off of the other levels as well. If instead we were looking at a bullish trade from R2, then we would turn on, and we wanted to look at a tight stop loss, and we would turn on the QL below R2 for a tight stop loss, or if we're using the standard stop loss, it's the first midpoint level below. For bearish trades, it works exactly in reverse. So for bearish trades, say off the R3 level, then you would turn on the QL above R3 for your tight stop loss in a bearish trade from R3, or to use a standard stop loss, it's the first midpoint above R3, the mid R3, R4 level. In the case of taking a bearish trade off of R2, standard stop loss would be the first midpoint above. You would turn on the QL level for the QL above R2. That would be your tight stop loss if you prefer to use that. If you were taking a bearish trade off of the R1 level, same thing, QL above R1 or the first midpoint above R1 for a bearish trade based off of R1. And for a bearish trade based off the bull bear KPL, the QL above BBKPL for the tight stop loss, or the standard stop loss would be the first midpoint above the bull bear KPL. And it works the same off of any of the other main key levels as well, as far as bullish or bearish trades. Now, what about option strikes to use? So with the daily key level strategy utilizing this indicator, there are two different types of options that you can use as far as expiration date. One is 0 DTE options, which means that those options expire at the end of today's session. The other is going to be 1 DTE options. Now we do have videos on 1 DTE versus 0 DTE, and we also have several videos that show the price differences between entries on those 1 DTE versus 0 DTE, and then also how the profits differed on those versus the entry prices throughout the session. So if you look in that Google Drive link again, you'll see a link to that particular video, and you can take a look at those videos which go over that and can show you the differences, and also what are the pros and cons of using 0 DTE versus 1 DTE for day trading the SPX, as there are some pros and cons of using each of them depending on your perspective. The main thing to keep in mind is that this indicator is for day trading only, so you will be opening and closing your positions all in the same session. So that is why it does not make any sense to use anything more than 1 DTE for that purpose, as you're not utilizing the options for swing trading, as you're not going to hold them over from one session to another or over several sessions. Okay, so as we went over, the tight stop loss is the QL on this bullish trade based on the R1 level. The tight stop loss, if you want to use that, is the QL below 6809.34. Standard stop loss is the first midpoint below 6805.40. Now with this indicator, your entry stop losses are going to be level based. However, as the trade progresses in your favor and you want to make an adjustment to your stop loss to break even or break even plus a profit buffer, then you're switching from a level-based stop loss, which is what you had at the entry, to a price-based stop loss. So when you're adjusting your stop loss after the trade has moved in your favor enough to break even or break even plus a profit buffer, you are then changing your stop loss from a level to price-based. Price-based meaning what you paid for the option, that would be break even, or adding a profit buffer amount to what you paid for the option, and that would be break even plus a profit buffer. Okay, now what about option strikes? With this indicator on a bullish or bearish trade from any of the main key levels, there are always going to be 3 option strikes that you can consider taking on any trade. So now I'll show you the process with this particular trade, and it's basically the same process that you would use. One is that you look at the direction of the trade. The second thing is, of course, knowing what level that you're basing the trade off of. So in this case, it's a bullish trade from the R1 level. So the standard play in this daily key level strategy on a bullish play from the R1 level is using an option strike as the closest to the R1 level. So the R1 level 68.1328. The closest strike to that is in SPX is the 68.15 strike. For those of you not familiar with SPX options trade in 5-point increments. So for example, 6800, 6805, 6810, 6815, 6820, 6825, etc. So the closest strike is the 68.15, and of course it's going to be a call option since we have a bullish trade. So the standard play is the at the money call option. At the money meaning not at the money for where it is closing, at the money based on the level you're taking the trade from. So in this case, the 68.15 call. Now we have the ask price on the 9:30 a.m. candle close is 24.20. The next, as I mentioned, there are 3 strikes total. So how do you figure out the next 2 strikes? Well, the next 2 strikes are going to be out of the money strikes. And how you figure what out of the money strikes to use with this indicator is that, again, what's the level we're taking the trade from? What's the direction? Bullish. You look up to the first midpoint level. And if this was a bearish trade from R1, we would instead be looking down to the first midpoint level. But since it is a bullish trade, we're looking up. You look at the level here, 68.2117. The closest strike to that is 68.20. So your next or option is going to be the 68.20 call option. And the ask price on the 9:30 a.m. candle close is 21.40. The furthest out of the money strike, and the third option that you have, is that you look one full level above. You're looking above because this is a bullish trade. If this was a bearish trade, instead we'd be looking one level below, and we'd be looking at this level for our third option strike to consider, taking a bearish trade off of this level. But since it is a bullish trade, we're looking one level above, 68.2905. So we are looking at the 68.30 call option. The 68.30 call option, the ask price $16.40 on the 9:30 a.m. candle close. And that process works the same off of taking a bullish or bearish trade off of any of the other main key levels. So like I said, let's say that you were taking a bullish trade off the bull bear KPL. Your at the money would be the closest strike to the 67.9751. Your 2 out of the money ones you could consider on this bullish trade from the bull bear KPL would be the first midpoint above, which in this case 68.0540, so that would be 68.05 call. This would be the 6800 call, and the reason it being is that it is slightly over the midpoint between 67.95 and 6800. So 67.9751 is just slightly above the midpoint. So that's why you would defer to the 6800. And the furthest out of the money would be the R1, one level above, 68.1328, and so that would be the 68.15 call. And if you were doing a bearish trade from this level, then you would look down and you would look, this would be the 6,800 put for the at the money on a bearish play from the bull bear KPL. This would be the 67.90 put on a bearish play. That would be your second option. And the third and final one would be look one level down, and it would be the 67.80 put on a bearish play from the bull bear KPL. Okay, so let's just keep this moving on here. Now, what about as far as targets? And with this indicator, there are two different types of trades that you can take with the daily key levels trading strategy. One is a scalp only trade and the other is a regular trade. A scalp only trade requires a one level move in your favor for a 100% exit of all of your positions. So in this case, on the 9:46 a.m. candle, we have an R2 hit. R2 is one full level above. Again, this is a bullish trade. One full level above is R2, so that is our scalp exit. If instead we were taking a bullish trade off of the bull bear KPL, then R1 would be our scalp exit, as that is one full level above. If we were taking a bullish trade off of R2, then R3 would be our one level scalp exit. And it works the same in reverse on bearish plays. You would simply look one level down from the level you're taking the bearish trade from, and that is your scalp target exit. Now with scalps, you are just exiting all of your positions. So it doesn't matter if you have one contract or two contracts, three contracts, 5, 10, 20, 40, or whatever. There's no stop loss adjustment. You are just simply exiting your trade. You're looking for the quick in and out. That's why it's a one level move only. Of course, there's because we're looking for one level moves only with scalps, there's going to be more scalping opportunities than there are regular trade opportunities in any given session because of the movement of price throughout the session. But before you enter a trade, it's a good idea to have in your head if you're going to make this a scalp only trade or a regular trade, because a regular trade takes a different profit threshold. And with a regular trade, with this indicator and this daily key level strategy, with a regular trade, you have several different options as what you can do once it has met the minimum movement threshold for a regular trade. So that doesn't mean you can't do a combination. You can't do some scalps and some regular trades. The point I'm just trying to make is that when you're entering a trade, you should know what your exit is going to be. So if you prefer to just take scalp, then you have a one level exit target. If you're going to do regular trades, a regular trade has a 1.5 level minimum required move for a regular trade. So for example, here at 9:56 a.m., we have a 1.5 level move. 1.5 level move, because one level move is to R2. Then we have the next midpoint level up, so that is 1.5 levels. Calculating it from the level that you're basing the trade from, the R1, it's a bullish trade. We look 1.5 levels up. That is our threshold here. Now before we go on with this here, we'll go back to this here with the scalp to go over the profits. The 68.15 call, the bid price on the candle close is $30, and these are shown over here. The entries are over here. And then we have the 9:46 a.m. bid prices on the candle close here. So $30 for the 68.15, profit $5.80 per contract, 68.20, 26.50 on the bid, profit $5.10 per contract, and then the furthest out of the money, 68.30, 20.20 on the bid, profit $380 per contract. Now go back to this note here. Remember, range of closing prices, that if you missed this entry here or you chose to ignore it and wait to see what was going to happen before entering in some subsequent candles, then you could have gotten some better prices from that. So if you didn't enter on this, then what we're showing here is the range of the ask prices on all of the candles that occurred from the 9:32 a.m. candle through the 9:42 a.m. candle. And the 68.15 call range was from 1980 to 2480 versus the 2420 on the 9:30 a.m. candle close. The 68.20, the range was 1720 to 2180 on the candle closes during that time frame versus 2140. And then the 68.30 ranged from 1260 on candle closes to 1640 as opposed to the 1640. Okay, so now going back to the mid R2, R3 hit the 1.5 minimum required threshold move for a regular trade. We'll go to the bid prices first. Those are shown here. 68.15 call, 37.50, profit $1,330. 68.20 call, 33.60 on the bid on the candle close, profit $1,220 per option. The 68.30, 26.10, profit $970 per option. Now, the regular trade differs not only because of the profit threshold, minimum movement threshold required, 1.5 versus the 1. With a regular trade, you have several options once it hits that minimum threshold. One option is that you can just go ahead and exit all of your positions, no matter how many contracts you have, and just go ahead and do that, and you close the trade up and then look for the next trade opportunity. The second option is that you can, instead of exiting, you can just modify your stop loss to break even or break even plus an initial 10 to 15% profit buffer. So again, we talked about when you start off your trade, it's level-based stop losses. However, when you get to an adjustment of your stop loss, then you're adjusting it to break even or better, break even being the price you paid for the option. So if you were going to do a stop loss adjustment here, let's say you were just going to adjust all of your contracts to break even, then when this is 37.50, you're now adjusting your stop loss from the level-based stop loss to now 24.20 if you were doing the at-the-money 68.15, or if you were doing the 68.20, 21.40 is what you paid, or the 68.30, 16.40. Now, if you add a profit buffer of, say, 10 to 15% above that, so you could just roughly say roughly $2.50 on this, roughly $2.15 on this, and roughly about $1.65 on this would be adding 10%. Now within the 10 to 15% range, you could make it easier on yourself and just add $2 to each one of these, and it would still be somewhat within that range. So you don't want to make it too complicated for yourself where you are giving up speed as far as your execution of adjusting your stop loss. You want to make it as easy as possible for you just to quickly and be able to react and adjust your stop loss. So I wouldn't get down in the minutia of figuring everything out to the exact penny as far as a stop loss adjustment if you're going to add a profit buffer above break even. Just keep in mind somewhere initial profit buffer would be somewhere in the 10 to 15% range, and just do a rounding up or rounding down to make it easy on yourself, so you would have speed in your execution if you're going to go that route and adjust your stop loss. Now the third option you can do would only apply if you're trading multiple contracts. Because if you're just trading one contract, your choices are either with one contract to adjust your stop loss or exit the trade. So that's pretty simple. However, if you are trading 3 or more contracts, then there is a third option, which is going to be exiting the majority of the contracts that you have. And what we mean by majority is approximately 70 to 90% of the contracts that you started with, and then adjusting your stop loss to break even or break even plus the 10 to 15% initial profit buffer on the remaining runner contracts. So for example, if you were trading 5 contracts and you sold 4 of them here when it hits this 1.5 level threshold, then you would sell 4 of them for the profit, and then you would leave 1 as a runner if you wanted to do that strategy as far as an adjustment of scaling out. And then you would adjust that 1 remaining contract to either break even or break even plus a 10 to 15% initial profit buffer. Now, whether you are just adjusting your stop loss on all of your contracts, or if you have multiple contracts you're doing a scaling out and leaving runners, then the idea is as price continues to move in your favor, you have the same decision to make at each succeeding level move in your favor. Either exiting everything you have left, or adjusting your stop loss, or doing some combination if you have multiple contracts and let's say you had multiple runners. If you had multiple runners left instead of just 1 runner, like let's say for example, you started off with 10 contracts and you exited 7 of them and you had 3, well then you could sell 1 here and adjust the stop loss on the 2 remaining, or you could sell 2 of them here at the next level up and then leave 1 runner, and then when it reaches the next level, then either exit or continue to that last remaining one, or adjust the stop loss further on that. By adjusting the stop loss further on that, that would mean at this point, uh, typically what that would mean is adding more of a profit buffer as price continues to move more in your favor. Okay, so we went over the profit per option on this on the mid R2, R3, 1.5 level minimum threshold regular trade move here. Now at 10:32 a.m. here, we have the R3 hit. That's now a 2-level move. So R1 to R2 is 1 level, then 1.5 levels, and then we have 2 levels to R3. R1 to R3 is 2 levels. That's known as the minimum ideal move. So this is the minimum required threshold, 1.5. By 2-level minimum ideal move, what is meant by that is that in 80-85% of sessions in a normal volatility year, a normal volatility environment, a 2-level move in your favor is generally going to be the extent of the majority of moves that you're going to see in an average volatility or even low volatility environment, somewhere between 1.5 to 2-level moves. Now, you can see moves beyond that as we saw today, but we're just talking about the majority. So there's always going to be outliers, there's always going to be exceptions, and there's always news that can happen during the session that throws everything off. As far as, you could have some great news comes out that now you get an extended move up that might go 4 or 5 levels, or you might get some very, very bad news come out, and all of a sudden you have a sell-off that may go 3 or 4 or 5 or 6 levels. Uh, so those things happen, but we're just looking for what's going to occur most of the time. And that's what's going to occur most of the time in low to moderate or normal volatility sessions. When you get to high volatility, sustained high volatility periods of time, and that would be, say, like the 2007, 2008 market and real estate meltdown that we went through, or the 2020 COVID pandemic period that we went through, where we saw very extended periods of time where we had very high volatility or even extreme volatility, And in those situations, more of the common moves that you would see would be more in the 3 to 6 level range, or even above the 6 level range. With this indicator, you can enable more than 6 levels above and 6 levels below if we ever get into a very extreme volatility situation. Those happen every now and then. If that ever happens with the V2 indicator, you can also enable levels R7 through R10 and S7 through S10 should we ever get into that type of situation. Okay, so on this two-level move, the bid prices on the candle close are shown here. The 10:30 a.m., 10:32 a.m. bid prices on the close, 49.20 for the 68.15. That's a profit of $2,500 per contract. 68.20 call, 44.60, profit $2,320 per contract. 68.30 furthest out of the money, 35.80. Profit $1,940 per contract. Now in today's session we have an example of how these other levels, the YDH, PMH, YDC, YDL, and PML levels can come into play. So for example, with regular trades, once price has moved more than 1.5 levels in your favor, as price continues to move more in your favor, you like I said before, you have a decision to make at each succeeding level in your favor. Normally what that means, each succeeding level move in your favor, would be another main level or another midpoint level. The QL levels are just used for tight stop losses. The midpoint levels are used for standard stop losses as well as gauging continuing momentum and additional waypoints for regular trades that have moved at least 1.5 levels in your favor. So that is the case normally. However, if any of these levels here happen to be in the way of price continuing to move in your favor after the 1.5 level move has occurred. So if any of these levels are in the same moving in the same or in this pathway of price continuing to move in your favor, they also become additional waypoints for decision making. So here we have the 1.5 level move. Now we have the 2 level move. The YDH, because it is after the 1.5 level move from where this trade started, it is now an additional waypoint. And then this midpoint here also is an additional waypoint, and then this here, because it is occurring after the 1.5 level move in your favor. The PMH level here is not after the 1.5 level move in your favor. Again, the 1.5 level move was here. The PMH was before that. If the trade had instead been taken and based off of the bull bear key price level, if this candle had been more down in this range here, the opening candle, and we had a bullish trade from the bull bear key price level, then the PMH level would have occurred after a 2 level move in our favor. So then that would come into play as an additional waypoint, and then this midpoint level here, and then finally YDH, and then this level here, and then this level here. Okay, so in this session at 10:44 a.m., the YDH level is hit, and you have to keep in mind that the YDH is an important level. It is yesterday's daily high, so normally it's going to take quite a bit of effort for price to stay above yesterday's daily high, continue to stay above and keep closing above and keep going back up. And you have to remember, we're already almost at mid R3, R4 from the bull bear key price level. And so YDH is not too far from that. So we're already getting stretched out quite a bit here. So with the YDH, we have another decision to make here. And it hits at 10:44. So this is an extended move for a regular trade. And here are the bid prices on the candle close of that 10:44 a.m. candle. 68.15 call, $59. Profit, $3,480 per contract. 68.20 call, $54.20. That's a profit of $3,280 per contract. 68.30 call, $44.80 on the bid. On the candle close, profit $2,840 per contract. All right, next we're going to look at the second trade of the day, and we'll move to that screen now. Okay, so now we're going to look at trade number 2 of the session. It is a bearish trade off of the R3 level. So we have the YDH level here. We try to get above it. It's starting to close back above it. It tried again to close back above it here. And so on many occasions, you will see the YDH level be a stopping point at which price will either stay at and around the rest of the day, or a lot of times it will reverse. If it starts staying closing above it on successive candles and it starts holding above it, then there's a good chance that we may also see a continuation of the rally. However, this YDH level is near the mid R3, R4 level, and so it is quite far away from the bull bear key price level. So in this particular session, a very good chance of a reversal, or at least just a stall out and a move sideways. So here we have price moving back down, testing it again, falling back off, unable to close again. And then we see this candle close here, the 11:32 a.m. candle closing below the R3 level. So here we have a 11:34 a.m. candle and 11:36 a.m. candle. So all three of these candles would have been within the acceptable range. So if you did not enter here on this close below, here on the succeeding candle, or you could have also entered here on this candle as well if you were wanting additional confirmation instead of the standard entry close below. So this standard entry close below is within the general context too of where we're at with this YDC level, how far we are extended, and unable to hold above YDH, the length between the YDH and how far it is away from the bull bear key price level. So you have to look at everything in context as well. So this entry here is on the close of the 11:32 a.m. candle, and again here you could have also entered as well on these two succeeding candles if you did not enter on this 11:32 a.m. candle close below. So here we have 11:32 a.m. candle closes below R3, 68.60.58. Candle is still within the acceptable range as we talked about earlier in the session. So this candle here is also within the acceptable range, and this candle here is also within the acceptable range. This candle here is also within the acceptable range as well. However, you also have to keep in mind that there is a great deal of space between R2 and R3. And again, you will be using the levels above the midpoint in the QL level, depending on tight or standard stop loss, for your stop loss. And then your R2 is going to be your one level target for a scalp. So you have to keep in mind that the closer it gets to R2, the further it is away from the stop losses you would be using based on this level. And then the reward of at least the minimum reward on a scalp trade of R2 starts decreasing quite a bit. So those are all things that you need to keep in mind. Okay, so again, like we did in the first trade, we have a range of closing candle ask prices that we've also got here that we'll get to in a second, that if you did enter on either one of these other two candles here, so you can see how those were. Standard stop loss, this is of course a bearish trade, so we're looking above. You turn on the QL level above the R3 for the bearish trade. If you're going to use a tight stop loss, that is 68.47. The R3 level is 68.58. The standard stop loss on a bearish trade from the R3 level is first midpoint above, mid R3, R4 68.7635. Okay, so now we have the three option choices. The at the money standard play 68, 60, 58. So the 68, 60 strike. This is a bearish play, so it's a put option. 68, 60 put option. The price on the candle close $11.30. Those are shown here with the ask prices on the 2-minute data boxes for the candle close of the 11:32 a.m. candle. Now the range on that on the two succeeding candles was anywhere from 1160 to 1930. So you can just keep that in mind as we go on. The first out of the money strike closest to the first midpoint below the level you're taking the bearish trade from, in this case mid R2 R3 68.4482. That's going to be the 68.45 strike. So that's going to be the 68.45 put option. Ask price on the 11:32 a.m. candle close, $6.20. Furthest out of the money strike we can consider on this R3 bearish trade is going to be one full level away, the R2 level, 68.2905. Closest strike to that, 68.30, 68.30 put option. Ask price on the candle close, $3.30. Now keep in mind that with no matter which strike you're doing on the trade, your stop losses are going to be the same on the entries as your level-based stop losses. So obviously here on the furthest side of the money, you have $3.30, which is per contract. So with options, if you're not familiar with how that works, $3.30, you multiply that times 100, that's your cost of one put option, $330. This one would be $620 for an option. This one would be at $1,130 per option. Okay, so again, scalp only, one level move in our favor. What's a one level move from R3? Again, the one level move is calculated from the level you're taking the trade from. In this case, R3, one level moves to R2. 11:54 a.m., R2 hit, scalp only. Again, scalp only, 100% exit of all contracts. If you're just doing a scalp only, 68.60 put, 34.50. Those are shown here, 11:54 a.m.s. 68.60, 34.50 bid on the candle close, 11:54 a.m. candle. 68.45, that's a profit of $2,000 on that 34.50, $2,320 per contract on the scalp. So that's quite a bit for a scalp. 68.45, 23.30, profit $1,710 on the scalp. 69.30, again, that was a 3.30 entry. 14.70, profit $1,140 on the scalp. Now at 12:04 p.m., we have the mid R1 R2 hit here. Here was the scalp hit on the R2. Now we have the 1.5 level minimum required move, minimum required threshold move for regular trade. 12:04 p.m. here, mid R1 R2. Again, R3 to R2 is one level move, mid R1 R2 from R3 is a 1.5 level move. So that's our minimum required threshold for a regular trade, where we have all the options for handling a regular trade that we went over with on trade 1. So we're not going to go through that again. If you would like to re-review that, just go back and look at that. Okay, so here we have the 12:04 p.m. data boxes here. 68.60 put, 42.40 on the bid, profit $3,110 per contract. 68.45 put, 29.80 on the bid, $2,360 profit per contract. The 68.30 is now at $19.70, so that's $1,640 a contract. Again, the entry was $3.30 on that. At 12:12, we have the hit of the R1 level. So R1 level hit, that's a 2-level minimum ideal move, as we went over with earlier in the video. So that is a minimum ideal move on a regular trade. Again, calculating from R3, 1 level, 1.5 level, 2 levels. These are shown here. 68.60 put, 51.80 profit 4,050 per contract. 68.45, 38.70 on the bid. On the candle close, profit $3,250 per contract. And the 69.30 is now at 27.10. That's a profit of $2,380 per contract, again starting at 3.30. 12.14, we have the end of the move here, at least for temporarily. As you can see, hits right on the mid BBK PLR1. So now we have one level, 1.5 levels, 2 levels, 2.5 level. 2.5 level extended move. Here are the candle close. Here are the data boxes for the candle closes for this. For the bids, 68.60, $55 on the bid. On the close, $4,370 profit per contract. 68.45 put, 41.70 on the bid. On the candle close, profit $3,550 per contract. 69.30 is now 29.80, profit $2,650 per contract. Again, 29.80 from 3.30, 41.70 from 11.30, $55. Excuse me, 41.70 from 6.20 on the 68.45, and then finally the standard play 11.30 entry now $55. Okay, so that's going to wrap it up for today's video. If you are interested in purchasing this indicator, you can, in return for taking your time for watching this video today, you can send us an email at daytradinggps@gmail.com to request a discount promo code, and you will receive a substantial discount on the purchase of the indicator. So again, just send us an email at daytradinggps@gmail.com to request the discount promo code, and we will send you the discount promo code for a substantial discount on your purchase of the indicator. All of our indicators currently are sold on a one payment for lifetime access basis. That means that you make one payment and then you have access to the indicator for life. Lifetime access also means any future updates to any indicator. So if we make any future updates to any version of the indicator, you also get those included. And then if we also come out with any future versions of the indicator that have additional features added, then you will also get those at no additional charge since you have lifetime access. Now we are going to be coming out with a V3.0 version of this indicator very soon. At that time, the price will be going up substantially from what it is now. However, if you do purchase the indicator now with the lifetime access, the V2.0, you will receive the V3.0 at no additional charge, whereas if you wait, that's fine as well. It's just that the price will be going up substantially from what it is now, whereas now you can purchase it at the current lower price and also apply the promo code if you request from us by sending that email. Also, we're coming out with some exciting new additions to the SPX indicator. That will be some bonus indicators that we're also going to be including. All of our subscribers right now who are using this indicator will be getting these bonus indicators at no additional charge. And it is going to be the SPX VWAP and the SPX volume indicator. So those are going to be some additional indicators that will be included as a bonus. We're going to release those bonus indicators probably within the next few days. Everyone who is already a subscriber will be getting them, and then anyone who subscribes currently or after will also be getting them as well. If you're already on TradingView, as you may be familiar with, the SPX CBOE index on TradingView, the data provider CBOE does not provide volume data for SPX on the SPX CBOE symbol. And they also do not provide volume data on the XSP, which is the mini SPX index option. So that trades at 1/10 of the normal SPX contract. So volume is not provided by CBOE to TradingView for either one of those symbols. So that presents a challenge for anyone that wants to utilize VWAP or volume. However, we are now going to introduce, and we'll be making some videos on these that we'll post to our channel, a VWAP that does work on CBOE SPX, and also a volume indicator that also works on CBOE SPX, and it will also work on the XSP symbol as well if you prefer to trade on XSP on the mini options index version of the SPX index, which trades at 1/10 of the value of the normal SPX index. So those two bonus indicators will work on either one of those symbols. And also, just want to mention that among the additional features that will be on the V3.0 version of SPX Daily Key Levels when that version comes out, it will have many new substantial features. That is why the price is going up on it. But one of the minor additional features that will be added to it is that the V3.0 version will also give you the key levels for the the XSP symbol as well. So for those that prefer trading on the XSP mini SPX index, because it trades at 1/10 of a value, which the options are going to also trade at 1/10 of the value as well. Many people prefer trading on the XSP because of the price of the options being a lot less expensive. Or as compared to the regular SPX index, as we've seen today, some of the options can get quite expensive. Then the V3.0 version, among having many new substantial features, will also have a minor new feature as well, as that it will also be able to give you the key levels for the XSP. All right, so thank you for taking the time for watching this video today. Please like the video if you enjoyed watching today, as it helps us with the YouTube algorithm. And if you'd like to be notified of when we post new videos to this channel, on regardless of what the trading topic is, whether it's a new SPX session video or whether it's a session video on stocks, ETFs, futures, Forex, or the NASDAQ NDX index, or on any other trade topic, please subscribe to our YouTube channel, and you'll also be notified when we post any new videos. So thank you again for watching today and supporting our channel, and we wish you much prosperity in all your future trading.